This is an analysis from Alpha Business Media. Welcome. In this strategic briefing, we're going to look beyond the daily headlines to identify the critical risks that are quietly forming just over the horizon for Nepal.
You know, this quote really hits the nail on the head. It perfectly captures where we are right now. We're so focused on the usual suspects, inflation, interest rates, and yeah, those are important. But that focus means we might be missing a completely new class of threats that could seriously reshape Nepal's entire economy.
So today, we're going to break down 3 threats that aren't getting nearly enough attention. We'll talk about a private credit time bomb, a potential inflation shock coming from, of all places, the Arctic, and something called psychological contagion from AI. And then we'll get into what it means to prepare for this new reality. All right, let's get right into it. When we look ahead to, say, 2026, the real dangers haunting the global economy, they're not your typical recessions. No, we're talking about something different. These are really complex, low-probability events that our usual economic models, well, they just don't see them coming.
And let's be crystal clear here. This isn't just some abstract academic exercise. These threats have very real, very direct ways of hitting Nepal's core economic pillars. We're talking about things that can affect remittances, the stability of our banks, even the price you pay for essentials.
So let's tackle the first big threat. This is one that's been quietly growing in the shadows, really ever since the 2008 financial crisis, just outside the view of the regulated banking system.
What we're talking about is private credit. Now, a good way to think about it is like a massive, global version of Nepal's own cooperative sector. But instead of personal loans, this is for huge corporations. It's this enormous, less regulated, and pretty murky system where big funds are lending money directly to companies.
And when I say huge, I mean it. This market is on track to hit something like $2.1 trillion in assets by the end of 2025. Just let that number sink in.
Okay, so here's where it gets dangerous. The real problem is this toxic combination of assets that can't be sold quickly and the potential for pure investor panic. So picture this. The economy slows down and more companies start defaulting on their loans. Suddenly, investors get spooked and they all want their money back at once. But here's the catch. The funds can't just sell off these corporate loans overnight. That creates what's called a liquidity mismatch, and the whole system just freezes. It's like a bank run, but in slow motion, and there's no central bank waiting in the wings to bail them out.
So you might be thinking, okay, that's a Wall Street problem. But it's not. The way this hits Nepal is direct, and it's through remittances. See, in a typical recession, remittances might dip, but it's gradual. A private credit freeze is a whole different beast. It would choke off funding for the very companies that employ millions of Nepali workers abroad, and it would happen almost overnight. That means mass layoffs, and for Nepal, a sudden, brutal shock to remittance income.
And that's the key takeaway here. This single event from halfway across the world could deliver a devastating 1-2 punch to Nepal. First, it hits our biggest source of foreign cash, remittances. But at the exact same time, it could freeze up the foreign investment we desperately need for things like our major hydropower projects. And that leaves our own commercial banks incredibly exposed to a wave of bad loans.
All right, let's shift gears to our second black swan. This one might feel even more distant, geographically speaking, but trust me, it could have a very direct impact on the price of, well, just about everything here in Nepal, from fuel to fertilizer.
So, I know what you're probably thinking. What on earth does melting ice in the Arctic have to do with a landlocked nation like Nepal? Well, the answer might surprise you. It has to do with, well, everything.
Okay, so here's the deal. As the Arctic ice melts, new sea routes are opening up. These routes are a game changer. They can cut shipping times from Asia to Europe by as much as 40%. And because of that, the Arctic has suddenly become a major geopolitical hotspot. You've got Russia, the US, and China all jockeying for control. Any kind of conflict up there, whether it's a blockade or a military standoff, would throw global shipping into absolute chaos, instantly.
Imagine it. A standoff forces hundreds of massive cargo ships to divert back to the old, already crowded shipping lanes. The result? A massive sudden spike in global freight costs. And those costs get passed directly on to us. We're talking about higher prices for cooking gas, for the fertilizer our farmers need, for construction steel, for pretty much all of our essential imports.
And what this shows so clearly is a type of supply-side inflation that our central bank really has no tools to fight. You can't fix a shipping crisis by raising interest rates. Okay, now for our final threat.
This one doesn't come from a market or a shipping lane. It comes from the silicon heart of global finance itself.
This is something called algorithmic fragility. What we're seeing now is a new generation of AI trading models. These things are self-learning, and they can show this unpredictable herd-like behavior. The scary part is, these black box AIs could all misinterpret the exact same piece of news or data and all trigger massive sell orders at the same time. The result? A flash crash that could wipe out trillions in minutes.
Now, you could argue that Nepal's stock market, the Nepse, isn't technically hooked into these global high-frequency trading systems, and you'd be right. But thinking that protects us, that's a huge mistake. The link isn't technical, it's psychological. Our everyday retail investors are plugged into the same global news cycle, the same panic-inducing headlines as everyone else. Just imagine you see a headline flash across your screen. Dow plummets 3,000 points in 5 minutes. In that moment, the why doesn't even matter. The panic is instantaneous, and that panic would spill over, triggering a wave of selling right here on our own market, driven purely by fear, not by the actual health of our companies.
So a global flash crash could set off a crisis of confidence here that our current safety nets, like circuit breakers, just aren't designed to handle. A circuit breaker might pause trading, but it can't stop the panic itself. So what does this all mean for leaders in Nepal? How do we even begin to prepare for this completely new landscape of risk?
Well, it starts with knowing what to look for. This chart breaks down the very first warning signs. For that private credit freeze we talked about, you'd look for a sharp, unseasonal 10% drop in remittances from the Gulf. For the Arctic standoff, watch for importers suddenly slapping on 25 to 40% freight surcharges. And for an AI-driven crash, the sign would be our own stock market, the Nepsi, hitting its negative circuit breakers within the first hour of trading.
You see, just understanding these early indicators is what allows us to shift from a purely reactive stance to a more preparatory one. Because here's the hard truth. Our current policy toolkit, which is all about managing domestic credit and government spending, is just not built for these kinds of massive external shocks.
If there's one thing to take away from this, it's this. Our sense of economic resilience is being seriously tested by a deep shift in the very nature of global risk. We're now facing storms that build up thousands of miles away, but can hit us here at home with incredible speed and power.
So, preparing for this future, it's going to take more than just tweaking a few policies. It's going to require a completely new way of thinking, a new kind of institutional imagination. Thank you for joining this analysis.